Well, good morning, everyone. Welcome to Long Verticals and Diagonals. My name is Barbara Armstrong. I am filling in for the fabulous Connie Hill today. I have got Kevin Horner riding shotgun in the chat. I want to thank all of you who continue to show up for this class every week. I actually used to teach this class. And so it's nice to be able to be back in the saddle for a couple of weeks. I'll be filling in for Connie this week and next week. And talking long verticals. Now, we do talk long verticals a lot in our trading a smaller account class. That's Mondays and Fridays at high noon. I will be treating today's class and next week's class as a companion to that. And so if you want to see the follow-up on the trades we're placing today, we'll follow up on the ones we're placing today next week in this class, but we'll also follow up on them in the trading a smaller account class. Okay, so good morning to Josh and Scott and Jack and the rest of the usual suspects. Will, good to see you. Will coming in from Austin and the rest of the gang. If you are new and you're here for the very first time, just know that you are joining this awesome community of people. We link arms together here and we are figuring this stuff out. So Connie has been talking a lot about diagonals in the last little while. So today we're going to focus on long verticals, and specifically we're going to look at long call verticals because the market has been pretty bullish. If you were in Kevin Horner's Trader Talks first thing this morning, things are getting bullish around here. And so that's going to be our focus for today. If you are not following Kevin and I in the land of X, you are missing out. My handle at Barbara Armstrong CS, Kevin's at Kevin Horner CS. You can also now find me on LinkedIn. So if you wander over to LinkedIn, you can find me there as well. Keep in mind, these are option strategies. Options carry a high level of risk and aren't suitable for all investors. We talk about the amount of risk we're taking on every trade before we place the trade. We are using the Paper Money software application on the Thinkorswim desktop platform. And this is just a great platform for you to learn to figure out a trading strategy and make sure you understand how to place trades on the platform and then how to exit trades on the platform before you consider trading in your live account. Know that short option positions will never be assigned early in Paper Money. That can happen in a live account. And actually, one of the things we're going to do today is we're going to look at an example trading plan for a long call vertical. And there's kind of a reason that we're doing that. So, I've got one quick announcement to make. Today, the focus will be on long verticals and really on placing some example trades. If you have never been to a live event, and the reason that I speak about so many of you with such affection is because I've been able to meet you in person. People like Frank Girardi and Sharon and Will and Josh and, all of these guys I've had the privilege of meeting because you've come to live events and you had the opportunity to meet each other. And I came to this education through live events as a client. And sorry, I'm trying to read the chat as I'm talking, and that is not working well. So if you've never been to one, I'd highly recommend it. Kevin and I will be in Chicago middle of May for I think this may be the first market drive of the year. And the thing that's so cool about market drives is we go from say what's happening geopolitically with the Strait of Hormuz down to, how our tariffs may be impacting our country and whatever else is happening, within our own borders. We'll look at sectors and what's happening within certain sectors. And then we come down and even look at individual stocks. And so it's a one-day top-down analysis on steroids. We'll have the coffee on. They're free to attend. We'll pay for your parking. And we'll have breakfast, lunch, and a great reception at the end of the day. And then I believe both Kevin and I will be in San Diego as well in June for a 2-day event, intro to technical analysis, and then intro to stock options. And then we're doing the same thing again in Chicago, middle of July. Okay, so, and if you just come to schwab.com events, you can register for these. We're also going to be at the end of May in Santa Clara, and this isn't on the chart because registration is already closed. Now, if you come to that event in Santa Clara, we'll register you on site. But it's important that if you're intending to come, just register. It's free. You don't have to lay any money down. And then we'll be sure that we've got, adequate seating and lunch and all the other things. Okay, so let's get out to the platform. So somebody asked if I'd be reviewing Connie's positions, and I will not be reviewing those positions today. Okay. So full disclosure on that. And I used to spend a few minutes or much longer doing an overview at the beginning of our classes. And I'm not doing that anymore because we now have Kevin Horner, who does a Trader Talks 4 out of 5 days of the week and does like a 45-minute analysis of kind of what's going on in the markets. And so now, we do the Coles Notes version in class, but Kevin's things are archived, so go check them out if you happen to miss it today. So the S&P 500, pretty close to a new all-time high here. After, going into correction territory, we have this V pattern, and, we had this bull flag pattern set up, and it looks like it's, off to the races again today. So that's looking pretty bullish. How about the NASDAQ? Well, it's hitting a new all-time high today, folks. So, it's pretty hard to call that anything other than bullish, right? Yeah. How about the Dow? A pretty similar pattern. It hasn't come up and knocked off this previous all-time high established on February 10th, but it's back in the neighborhood, for the Dow 30. And then the Russell, I mean, it's sitting right up at all-time highs. And we had all of, when we look at these bull flag patterns, right? A one-day pullback and it took off again, another one-day pullback, moving to the upside, a Harami pattern on the candle. If you're a technical analysis person, we had a Harami pattern yesterday and bullish again today. Yeah. Yeah, so like Kevin said, new highs are not bearish. And I think Lee Bowl used to say that. Yeah. And then if we look at, the sector indices, and this is a public watch list, who was at the top of the heap, for over the last 3 months, energy. And then it kind of got knocked off its pedestal because if we look at the last 4 weeks, it's gone from first place to last, and technology is back, screaming to the upside and, hitting a new high, technology, a new all-time high, communications up close to all-time highs, and again, bull flag patterns, right? Consumer discretionary on a tear. Diagonal resistance breakout, and it didn't even look back. Ran through the tape and kept on going. And so if you're thinking like, well, what sectors might I be looking at? These might be a good place to start. Technology, communications, consumer discretionary, just saying. Okay. Okay, so that's our market overview. So I'm going to bring up a watch list. I'm going to switch to a scratch pad. And why am I doing this? Because I don't normally, and we're just going to get rid of all this stuff. So we're going to do an example trading plan for a long call vertical. And the reason that I'm doing this in class today, we are going to have one that is, evergreen content, what I call, which is it's going to be in these trade management mini sessions. So if you haven't subscribed to the Trader Talks channel, you'll want to do that. And I've grouped this into sections. So the first section is all the shorts on candlestick patterns, and there's 13 of those so far. There'll be probably 18 or 20 by the time I'm done. But I also, and I was teaching 2 or 3 years ago this class. And so I created an example trading plan for long put verticals and one for short, short call verticals, short put verticals. I also did one for long call verticals, but these are now aging out and they want me to re-record them. And so you'll see these have all had thousands of views. The long call vertical one dropped off last week. So I will re-record it tomorrow or Monday of next week. So by the end of next week, you'll see a new example trading plan in this trade management mini sessions, and it'll probably be up at the top here. But and I'll post that on X once it's up. Okay. So that's where we'll see it. But I thought for today, it might be kind of interesting, since I'm filling in for Connie, to just do and go over the basics of an example trading plan. So, and a good trading plan covers, what to buy, when to buy, how much to buy, when to get out, both if the trade goes for you or against you, and then how do you manage, what's your routine? And so if we go through the what to buy, we want to look for candidates that, and I'm just making this up, that we want stocks that trade 1 million shares a day plus or more. Okay. And when we look at the options, and you might say, well, this is an option strategy. Why do I care about how much the stock trades? Because if the stock doesn't trade 1 million shares a day or more, likely the options are not heavily traded. So when we look at the options, sorry, I've been talking a lot this week. When we look at the options and we look at open interest, we want that open interest to have at least 20 times the number of contracts that we want to trade. And when we look at the options, we want the bid-ask spread. And as Ben Watson likes to say, if you say that really fast, it may not sound like I intended to sound. Bid-ask spread, we don't want it to be too wide. So we want it to be what's not too wide, under 10%. So if this option is $5, we don't want the bid-ask spread to be more than 50 cents. And this one's $1.70. And so you might say, well, can we trade it then? The answer is no, because that's one of our rules. And if it's breaking the rule, then we don't trade it. Okay. So that's our what to buy. When to buy would be when we have a technical entry on the charts. And so, what might that be? So that might include, say, a bull flag with a close above the high of the low day. That might include a horizontal breakout with a retest, with or without a retest. I can put that in brackets. Some might want to wait for the retest. Some might say, well, it broke through and it's continued to come up, or a diagonal resistance breakout. Those are 3 examples. So do we have an entry on the chart? And then how much to buy? And so our how much to buy might be, we might say, well, how much are we willing to lose? And you might say, well, that's kind of a negative way of looking at things. Well, that's kind of a realistic way of looking at things, right? So we might say our max risk per trade is $500. And that's what it is in our trading a smaller account class. So we don't want to risk more than $500. Okay. So, and then we might put some other things in there, like we might say for, what to buy, we might add time frame, is typically 20 to 50 days, somewhere in that time frame. And then our when, so that's our how much to buy, our when to exit. And we have changed this on occasion, but maybe our plan is to exit when we have a 50% gain or a 50% loss. And when the market's been really volatile, sometimes we've changed that and we've said, how about we make it a 25% gain or loss, like just a little win. And if we can get in and out of that in a week or 2 weeks, like if you went to, an Easter dinner with family and said, can you believe this crazy woman suggested that I get out with a meager 25% gain in a trade I'm only going to be in for 20 to, 50 days? They'd be throwing the dinner rolls at you. And we're saying, okay, we want to exit when there's a 50% gain or a 50% gain or a 50% loss. You see, I do have a positive disposition. And then what is our routine? And somebody asked me a question at the end of a webcast in the comments and said, do you have any webcasts that kind of talk about morning routines? And, I talk about a routine on a trade by trade basis. So our routine might be to daily to check the position to see if close to our target or exit. And why do I say it that way? Well, let's say you're up 40%, and then you notice when you come here, do we have, here we have our long call verticals. Are we close to being up or down 50%? Well, on this Corteva, we're down 50%, and we put in a target, but we don't put in an exit. And so we want to manually look at these. And how long does it take us to look at 4 trades and say, are we close to our target or exit? It took us about 5 seconds. And then Corteva, well, we need to look at that one. Okay, that's downtrending. We bought it on this day when it looked like it was, we had a bull flag type pattern. That hasn't worked out. And so what are we going to do? We're going to follow our rule. And so we're going to come up to our working orders for Corteva. And we are going to right click on that trade, cancel and replace. But the expectation was we were going to get out for 385. Yeah, that's not happening. So we'd like to exit for, if we can get $1.50, we live to trade another day. But that's our rule. And now we're down 50%. So we're exiting that position. So I just demonstrated trade management. Okay. Okay. So here's our example trading plan. Pretty, simplistic, but you can use this from which to create your own trading plan. You might say, well, I want the stocks to trade 5 million shares a day. I want there to be 100 times the contracts. I want the bid-ask spread to be under 5%. I mean, you can make it whatever you want. And then, just continue, continue to hone your plan until you have one that you're cool with sticking with. So let's look at some examples now. Well, now Lam Research, we're on the other side of earnings, but now we have this candlestick pattern that was bullish when I was looking for examples this morning, and now is, we've got this this doji pattern, this pattern of kind of indecision. So let's go look at another example. So let's look at travelers. And so one of the questions that I get asked a lot is, how do you pick your examples? And full disclosure, I went to the watch list and I pulled up the stocks on the Dow and what I was looking for. And then, I looked at some stocks on the NASDAQ. I sort them alphabetically. So as the market is changing, it's not whipping things around. And then I looked for things that don't have earnings coming up, that don't have a little blue dot. And why would I do that? Why do I want to avoid doing this over earnings? Because if it gaps up, like TXN today, Texas Instruments, gapped up 16%. And so if we had done a long call vertical on this week, like, we would have been happy campers, right? But what if we had done a long call vertical on now and then it gapped down? And we could have justified that. We had a diagonal resistance breakout, and so, sometimes things don't move that much, but sometimes they do. And, it can go either way. And, it doesn't always seem to make sense, how the market reacts. And it's hard for us, like my crystal ball has been in the shop for a long time. And so I don't want to take that earnings risk. And so I'm looking for something that either earnings isn't until the middle of May or earnings has already come and gone. Okay, so when we come back and we look at Travelers, and I say, oh, okay, well, we've got a diagonal resistance breakout. We've already had earnings, and it beat on earnings. So check, check. We can come and say, well, what are the analysts doing with this thing? Well, they're raising their targets, from 297 to 314, 317 to 321. We have one that's lowering, Wells Fargo, but everybody else seems to be raising targets. So that seems pretty bullish. Then we come to the trade tab. We go 390. It only offers monthlies. That's your first ding, ding, ding. That may not be so great. But 390 and 480, you could drive a truck through that. And somebody asked, what deltas do we tend to look at? So with a long call vertical, we tend to straddle the current price. So we tend to in this one, and the other thing is these are $10 wide. So when we look at this, in this example, we're already halfway through. We do the 300 and the 310, but we're not going to place this trade because what rule does it break? The bid-ask spread rule. Okay. Like it does, we're early in the day. I mean, typically, like yesterday, this traded 1.4 million. So it typically trades more than 1 million shares a day. We're early in the trading day yet, but it doesn't meet our bid-ask spread criteria. And either you have a rule and you follow it, or you don't have that rule. But it can make it harder for us to get out at the kind of profit we want. So if we look at Goldman Sachs, like, does this look at all like the 4 indexes that we looked at, kind of pulled back and then, now bull flagging its way to the upside. And yesterday we had an inside day. That's a Harami pattern. It's considered a complete pattern, in that. But, today we now have, some would argue a bullish engulfing. So we're stacking bullish patterns on bullish patterns here. And this is an expensive stock. So, we only have just over a $30,000 account here. So if we said, okay, I couldn't afford to buy many shares of this stock. If I wanted to buy shares, our max position size is 5,000. But could I participate in what I believe will be a continuing uptrend by coming out and doing a long call vertical? And here we're at 29.50 and 32.50. So it is about a 10% bid-ask spread. We've got lots of volume on, our options on an average day. So yesterday, it traded over 1 million shares, and that was a relatively light day. So we're check, check, check. Okay. Now, and again, we're straddling the current price. Now, couldn't we just go out and say, do the 945 and the 950 if we're really bullish? Like, what would be the advantage of that? Well, the advantage would be that it would cost us less to buy the long vertical. But then it has to go up more. So our probability of success is less. So when we look at this 940 and 945, I put these 2 columns in here, probability of in the money, probability of touching. You've got a 97% chance, 96.5% chance of it coming up and hitting that 940, and a 97% chance of it hitting the the 945. You've got a 48% chance of it being in the money at expiration. And so we just want it to go through long enough. We want it to go through this 945 and stay there. And then we want it to do that for long enough for us to get our 50% gain. Okay, so we're going to say, okay, 295 times 1.5 is 442. So let's round, we'll make it 440. We're going to do two of these. Well, no, we're going to do just one if it's at 295. $440, because that's almost $600, and we might go $550 in this class, but we don't want to risk 600. And so that might be another reason you might say, well, then why don't we go out further? It's like, because we're trying to, we're trying to create a higher probability trade. Where if we looked at the 945, 950, it would only cost us $2. But then it has to go up $8 as opposed to going up $2 and $7. It would have to go up $7 versus $1.70. And and I'm using, round numbers there. And that strategy has worked, pretty reasonably well for us over the last few years. Now, let's look at NVIDIA. So first question is, we're tiptoeing through earnings season. So, when is earnings? May 20th. Okay, if we do the May monthly, that's May 15th. So we'd be out of this prior to expiration. Now, we had been trading iron condors on this stock because it's been trading in a sideways range for quite some time. It had this big run to the upside, and then since September has been trading in this range. And now it's broken out. And so, could we do a long call vertical on this? It's at 202. Could we do the 200 and the 205? And the question you might ask yourself, are you bullish on NVIDIA? Yeah. Okay. I'm just looking at. Oh, somebody said, Tony taught us in the very beginning that you will lose money on trades. Yeah. So it's very important that, you embrace the fact that there will be some trades that aren't successful. So we just closed out of a trade that was not successful, CTVA, but or that did not make money. Yet I would say it was a successful trade if we entered on a legitimate entry, we followed all our rules, and we got out when our rules said we should get out. So it was a successful in that way. It just turned out to be a trade that did not make money. Okay. Yeah. And we had done, yes, we exited the short call vertical on NVIDIA in the other class. Okay. And so, and then there are some that might look at this and say, well, when we come in here, it's still not that far off this line. We did get up to 212 at one point, and it turned out not to be a breakout. It was a fake out. And so you may not want to do that. You may choose not to do that. But if we said, okay, if we're bullish on NVIDIA, if we come out to May, do we have a tight bid-ask spread? Well, this stock has already traded 40 million shares today. So has it met that criteria? Check. Okay, so check. It's met that criteria. When we look at open interest, 46,000 contracts. And if we did the 200, 130,000 contracts. We've had thousands of contracts, just traded today. So check. Do we have a technical entry on the chart? Well, that was a check. And then is the bid-ask spread tight? Well, it's 10 cents. So check. So we've got check, 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 check. Yeah. So we're good to go. Now, does this guarantee that it's going to be a successful trade? Well, look at Corteva. There are no guarantees. So somebody's asking about the short call verticals. I'll discuss that tomorrow. We've exited all of them. All of them. I think I should be sponsored by this market, because every time I place a short call vertical trade this year, it seems that the stock rallies. So yeah, we got out of that NVIDIA trade there. Okay, so we're going to come here, look at the 200. We're going to buy a vertical, and it will automatically put in the smallest, the next available strike. We're going to change that to the 205, because we're almost at 202.50. Now, we don't have to do that, but if we said, okay, we're willing to do the $5 wide, and I'm going to multiply that 265 times 1.5. We're going to do 2 contracts. We're going to right click, create an opposite order, and 265 times 1.5. When it gets to 395, we're going to exit. Now, if we get to the point, if we were looking at our trades and doing our daily review, and we were up 40%, but we noticed that today we're down a little bit, we might say, well, if it's a hanging man or a shooting star or something like that, we might just say, hey, we've got 40% or 45% of our gain, like, let's not be greedy. We're close. It looks like it may be pulling back. And that's why we want to look at these every day. Or it could be that we're up 35% in just a few days. And then it looks like it's going to start pulling back. We could say, hey, I'm going to take that 35% and call it good. Let's look at Target. So consumer discretionary. At least I think it's consumer discretionary. Oh, so interesting. So many things are now starting to pull back. So we may look at this one again tomorrow. Let's come to the Analyze tab. Oh, Target is considered a staple. Who knew? Most of the things I would look for in a Target are discretionary. But I guess Target now sells groceries. So this is setting up a bull flag. But if you trade a bull flag pattern, one of the things with a bull flag is, if we have this inverted hammer at a potential support, this candle pattern requires confirmation. And so someone who's more aggressive might say, well, I think that it's going to go up tomorrow. But, there's a line that experienced traders say, we don't trade what we think, we trade what we see. And do we see a close above the high of the low day yet? And if you're new to this, you'll hear people referring to this as a hold. Do we see a close above the high of the low day? Yeah, I say nay, nay. Yeah, we do not. And so, that says, okay, we're going to wait. So, tomorrow in our trading a smaller account class, we can look at this and see if we have that close above the or trade above the high of the low day. So, but yes, it is this is a flag formation. But do we have confirmation that it's finished pulling back yet? Yeah, we do not. We don't. And so, what are we going to do? Take one hand, take the other hand. We're going to sit on them. And we're going to wait. Now, and others might say, oh, God, what a pill. like and yeah, but it's like that second part when we come here to our example trading plan and say, on our when to buy, oh, oh, I screwed, you know, do we have that technical, do we have a bull flag? Yes. Do we have the hold bit? We do not. So what are we going to do? We're going to be patient. And, like I, I remember saying to my son one time when he was really little, capiche? He said, Mom, I don't like capiche. It's like, it's like patience. I don't like patience. Yeah, well, okay, moving on. Okay, how about Walmart? Have we looked at Walmart yet? So, I kind of think of these guys as neighbors, right? So is this it's also considered a consumer staples, and somebody said that they like to go to Walmart to buy DVDs. I didn't know anybody still sold DVDs. So now I want to go to Walmart because like I have a wall of DVDs, full disclosure. Um, yeah, and so, when we look at this chart, if we're doing our technical analysis, and if you're new to technical analysis, feel free to join me on Tuesdays for getting started with technical analysis. But, we had this kind of breaking down, and some might say, like, she teaches technical analysis seriously? I would have drawn my line here. Well, if you drew your line here instead of here, like it broke out, came back to retest, remember? Diagonal resistance breakout, with a retest when we have a breakout. So this one has retested, came up, came down again, moving again to the upside. And so you may say, well, but, isn't it kind of extended? And while it might be, but if we're giving ourselves 25 days, if it pulls back for a day or two, is that going to be a trade killer? Not necessarily. And so, others might look at this and say, I don't know about all these lines. Let's, clear that. And what I looked at when I saw it, and, this is where technical analysis, they say love is in the eye of the beholder. When we look at this, some might say, I see a horizontal resistance breakout and I see like this inverted head and shoulders, in which case your timing is perfect. So if we look at this, here's our inverted head and shoulders, and it's broken out. Now, when is earnings coming? Well, there's another question. Thank you for asking. So if we hover over this, May 21st, well, that's after the May monthlies. So if we say, okay, well, if we come out to May, does it trade more than 1 million shares a day? Check. We're already there. Whoops. So check on that. If we're going to bracket it, we could look at the 130 and the 135, or we could even do, this has, $1 wide strikes. So could we do that? Like, how much volume do we have? Tons on all of these. Now, if we go $5 wide, we've got a ridiculous, like 13,000. Looks like somebody else had a vertical idea, don't you think? Did a huge volume here because these numbers are pretty similar. But you've got a 20-cent bid-ask spread. Here you've got a 6-cent spread, 11. Like, so check, check, check. Do we have an entry on the chart? Check, 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 check. Okay. So the next thing is, well, which strikes do we want to look at? And so we could compare and contrast with this, and we could do two different trades. So let's do that, and then we'll compare them. Okay. So one of the things that some people will say is like, well, why would I want to do a bunch of contracts, with this $1 wide spread? Because I have to pay 65 cents per leg per contract, or $1.30 per contract to get in and $1.30 to get out. Where if I do this 130, 135, but then the stock has to move further. It has to move up to basically a previous high for us to have, our max gain on that trade. Where if we do the 131, 132, it only has to move 80 cents. It doesn't have to move $3.80. So it just, these are all things that we have to take into consideration. So if we let's first look at this 131, 132. And I kind of like it when it's about halfway. So, if we come to confirm and send, we're risking 52 to potentially make 48. And if we have to pay, 260 per contract to get in and out, if that's 10% of our gain, are we okay with that? Well, it's kind of part of the cost of doing business is how I look at it. And so we could let's do 5 contracts here. And we could do 10 if we were just doing one trade. And we're going to say when this is worth about 75 cents, get us out. That's about 50%. We're putting that in our long call vertical group. And we're going to compare this to the wider strike position. And then we're going to do another trade at 130 and 135. And we'll just compare them. And so this is only going to have one, set of transaction fees. The others will have 5 contracts worth. So this is 229. So relatively speaking, is costing us less. But the probability of it getting to 135 and staying there isn't as high. So we're going to do one contract so that we're risking about $500 in total on these Walmart trades. And we're going to make this 343. And long call vertical. And we're going to compare this to the dollar wide strikes. And that just reminds me, so it's a note from myself to myself. Okay, so one of the things I get asked a lot when there is a survey, and I don't believe we have a survey today, so you're off the hook on that, but it's like, what did we do today? And so we created an example trading plan. So that was number 1. We showed how quickly we can manage our long vertical trades by just coming in, having a glance and seeing where we needed to take action. So we did some trade management. We placed 4 new example trades, one on Goldman Sachs. And then I'm going to come over to time the orders placed. And then we have teed up orders on NVIDIA and 2 different trades on Walmart. So we've done 4 example trades. So in our note to self, if we want to see those notes, we can just come in here and click on this little note and it'll tell us, our note from ourself to ourself. Yeah. Yeah. Okay. So guys, that's a wrap. I want to thank Kevin Horner for his participation in the chat. I want to thank the guys behind the scenes for helping bring this class to life. I want to thank each and every one of you for continuing to show up. And here's my ask of you. If you haven't subscribed to the channel, there's lots of great content over on Trader Talks on YouTube from Schwab Coaching. So hit the subscribe button. It's in the bottom right corner of your screen. Then you're also going to want to hit the like button. It lets me know and Kevin know that you found this content valuable. And so we'd appreciate that. But more importantly, it helps move this up in the algorithms on YouTube so that more people can find this content. Oh, there we go. One of our Walmart contracts got filled. And I'll make sure that they all get filled. Yeah. And so that's a wrap for today. Thank you for joining us. Up next is, I think, trading with dividend stocks. And then James Boyd is on the roster today. Lots of great content still to come. So be there, be square. I'll see you guys tomorrow for trading a smaller account at high noon. And now I'm going to go silent. So, guys, have an awesome day. Bye for now.